Hi, welcome to the Power Forward Pod, hosted by the Power Forward Group Financial Advisory Team, where we believe two is better than one, dialogues are better than monologues, thoughts were meant to be challenged, sound boxes are the enemy, and change is the only constant. I'm Bobby Kaslander. I'm joined here today by my partner in crime, Joe Shalom. How are you, Joe?
Hey, Bobby. How's your Thanksgiving?
It was good for the most part. Yeah, we actually hosted some family over, which was nice. Had a little accident Thanksgiving Eve. Had to get 5 stitches in my thumb.
Oh, so you cooked the turkey?
I did. Yeah.
Stay out of the kitchen, I think I learned.
Stay out of the kitchen. That's the lesson I learned. Yeah, but it was good. Yeah, how was yours?
It was great. I spent the weekend with my in-laws in Jersey, so
Great.
It's a good 5 days reason to escape and not have to go too far.
Nice. All right, good. Well, it's good to be back. As year end's approaching here. So I think really the goal of today and what we're going to be talking about is really providing our listeners with a basic understanding of the stock market, right? What it is, how it works, what really drives stock prices up and down over time, different exchanges, indexes, what is an ETF, what are stocks, what are bonds, and really why it's so important for people to be investing for the long run.
Yeah, it's funny. I was actually talking to one of my friends' moms over the weekend, and she was saying that she picks her stocks based off of her Instagram. I said, what does that mean? She goes, yeah, I follow people, and whatever stock they say to pick, that's what I do. I said, oh, how's it working? I don't know. I haven't looked at it. So I think this is very important because I think there's a lot of fake financial advice out there, and absolutely. Education is very important.
100%. Yeah, and you got to be cautious definitely with the whole TikTok, Instagram movement. You see all these financial influencers out there. You really got to be careful about those. So I think for me, what over Thanksgiving holiday, I actually recently, and you and I were talking offline about this, but I recently had dinner with some old friends of mine. We've been friends a long time. We all know what we each do professionally. Several people came up to me. They were asking me, what should I be doing with my money? What should I invest in? Really, what's out there? What's the hot stock right now, right? So,
love that question. I always get it all the time.
Of course, right? Everybody's looking for the next, overnight success. But what I essentially gathered from our conversation and just, asking them a couple questions, it sounds like most people, I'm sure your friends are similar. They invest some amount into their 401k or, employer-sponsored plan, most of which had no idea what they're invested in. For all they know, they could be invested in a money market account or just holding it in cash. So that's another topic we can go into. But outside of that, I gathered most people I was speaking with, they invest some amount into the 401k and that's it, right? They'll put the rest in a savings account. Some don't even have a high yield savings. So I started just briefly giving a high level description of, taxable brokerage accounts, right? Why it's important, why you want to be contributing in the stock market for the long run. Trying to give a very basic elementary explanation of it. And
let's take a step back,
yeah.
Bobby, right? Maybe most people don't even know what the stock market is, right?
Right.
It's a word, invest in the stock market, but what does that actually mean? Am I just going and buying Apple?
Yeah, good question. Yeah, so I think that's really what we're going to dive in today. Like, what is the stock market, right? What does that actually mean? And the benefits of it and why young investors specifically should make sure that they're investing in the stock market, right? So let's break that down, right? What is stock? So stock or equity, I think those two words are very interchangeable. They can be used in the same fashion. It essentially means a small piece of ownership of a company, right? If you own a stock, you're essentially a small owner of a specific company, right? Let's take Apple, for example, right? Apple has approximately 15 billion shares outstanding, right? So if I own 100 shares of Apple, right? Shares, all that really means is quantity. Stock equals ownership, right? So I'm a part-time owner of Apple. So companies they issue stock so that you can purchase ownership. They do that to raise capital, to fund new business ventures. So when you think of the word stock, you can think of an ownership, right? You're an ownership of the company.
So
yeah,
the goal is I want to pick companies that I know. How do I decide what type of companies I want to buy then?
Yeah, that's a good question. So we can definitely dive into that, like, why it might make sense to own ETFs or mutual funds instead of individual stocks. We'll jump into that. Let me first touch on like what the market is, right? So we broke down stock. What is a market? So a market is really a place where you can buy and sell stocks, right? It's a market. In order for companies to be listed on the market, right, they have to go through what's called an IPO, right, an initial public offering, right? My father has a lumber business, that's a private company. You can't just go randomly on the market and purchase shares of it. So you have to go through what's called an IPO, right? An initial public offering. Companies that are public will list their stocks on exchanges, right? You may have heard of, for all of our listeners, right, the New York Stock Exchange, the NASDAQ. Those are essentially those are exchanges where you can purchase these stocks. Now, generally, we measure the stock market through indexes, right? The Dow Jones, the S&P 500, the NASDAQ, right? I'm sure most people have heard or familiar what the S&P 500 is, right? It's essentially the largest 500 U.S. companies, right? It's a very elite status club. Companies can actually really be kicked in and out of the S&P 500 on a quarterly basis. So when you think about the stock market, all it really is it's a bunch of companies that you can purchase, right? So it's a marketplace where you can purchase individual stock ownership of different companies.
So where do I buy it? I got to go to the New York Stock Exchange in next to our office on FIDI?
So you can purchase them through types of brokerage accounts, right? Like, companies such as like Vanguard, Fidelity, Charles Schwab. These are brokerage houses where you can create accounts, and they make it very easily for you to be able to purchase stocks, bonds. We can get into that, ETFs. So they're kind of like the intermediary where you can purchase all these things. Yeah.
Yeah. Well, you just said bonds. Let's back up a second, right? Because when people think about the stock market, sometimes there's bonds in there, right? I don't know if everyone fully understands the difference between a stock and a bond.
Yeah. Yeah. Why don't you take us through what the difference of a bond is, right, and how that differs from a stock?
Yeah. So if I think you gave Apple as the example, right? Apple says, "Hey, I want to raise money." So there's two different ways they can raise money, right? You explain what a stock is. That they said, "Hey, I'm going to sell a piece of my company because we need money." So that's what a stock is. Now, there's some risk associated with it because now you're an owner. So if the value of the company goes up or down, your holding value goes up or down. Now, what a bond is Apple saying, I don't necessarily want to give away a piece of my company. I want to own all of it. So what I'm going to do is I'm going to raise money by taking a loan out. And that's a bond, right? They're borrowing money. So they go to people and say, hey, let me borrow, $100,000, $1,000, $100, whatever it is. And they issue you a bond saying, I'm going to pay you 3% interest, 4% interest, 5% interest, whatever it is. So you're lending them money as opposed to owning a piece of the company, you lend them. Now, the difference really between stocks and bonds is the risk associated with it. Mm-hmm. The stocks will go up and down based off of the value of the company. But bonds don't really move that much just because it's an IOU. So when people think about the stock market, for the most part of our conversation today, we're just going to be talking about stocks, not bonds. Right. But there is a safer way to diversify and invest across the broad markets as a whole.
Okay. Yeah. So I think that's a helpful overview. So in general, stocks, you would say, are a little bit more risky, but they carry more reward potential. Is that correct?
Exactly. Yeah. Well, that's always how it is, right? More risk, more reward. But there is value in diversifying, right? The purpose of what we're going to say is don't own just one stock. Right. The same idea. There is value in having bonds because it helps with some of the risk. Right.
Right. And if you take, and we'll jump into this, but if you're investing all of your money in just one specific stock, you're taking on a ton of risk, right? We always joke, we use this example with clients, but let's say you had a couple $1,000 and you just invested in Amazon stock, right? Now, one day, maybe Jeff Bezos decides to go to space because that's what all these billionaires love to do these days. God forbid something happened to him, didn't come back, right? You might see a tank in Amazon stock. So you're taking on a lot of risk within one single company. The flip side of that is you have high reward, right?
Amazon's done really well lately, right? But most people, I don't think either notice that, they look at it from, if I invested in Amazon 20 years ago, I'd be in a great spot today. Right. They don't look at what happened over the past 20 years. So it's not necessarily gone up every single year. Okay. Some years it goes down, some years it goes up. Right. Which I think is very important to understand the diversifying of that.
Yeah. So talking about diversification, right? So for young investors or people that aren't fully aware about the whole stock market world, what is an easy way to diversify, right? Rather than just owning a single stock, are there things, can you do things to really help diversify investments?
You could buy more than one stock, that's for sure. But yeah, that's hard, right? How much money are we talking about here that they're going to invest? If they say, hey, I'm investing $1,000, it's very hard to buy 1,000 individual stocks, $1 in each. Right. So that's where there's this thing called ETF, which you mentioned before. Just stands for exchange traded fund, which again still tells you absolutely nothing. I always called it electronic traded funds, but I learned a little bit better. Right. But the idea there is that what it can do is basically buy micro shares of many different companies. Okay. And there's many different types, right? You mentioned the S&P 500. So there's an ETF that tracks the S&P 500. So you can buy this one ETF, which trades on the exchange exactly the same way a stock does. Yeah. But within it, there's 500 different companies. So for the same $100 you wanted to invest in Apple, I can now invest in this S&P 500 ETF. So I could effectively own 500 companies.
Right.
And there's many different types of ETFs, right? There's some that track 50 companies, some that track 3,000, 4,000 companies.
Right. Yeah. There's different sectors you can invest in too, right? Some investors like to invest in financial companies, right, by themselves, or maybe healthcare companies or consumer discretionary. You can buy.
There's even one that's the total stock market. Every single stock on the market you can buy.
Exactly. Yeah. So I think ETFs are definitely the way to go, right? They're a very low cost way to diversify yourself. And they're great for investors who are just getting started, who really don't know much about the stock market. We'll dive into some statistics going forward and like why it's so important to invest in the market. But I think ETFs are a fantastic place to start for young investors.
Yeah. Well, I guess part of that is when should we start? When should an investor start? Is it, when I have enough money? When's the right time?
Yeah. Well, I think the right time is yesterday. So it's always a good time to invest in the market. But I think it's the same thing we tell our clients, right? Investing in the stock market and the reasons why you want to invest are great, but when should you start? Like, when does it actually make sense? So what we always tell our clients is, I think you want to make sure you have some sort of a safety net just set up in place because, God forbid you lost your job, or maybe there was an emergency that came out where you needed to outlay, a significant amount of cash for, maybe it was a medical expense or some sort of an emergency, right? We call that an emergency fund. Now, for most people in the financial advisory textbook, will tell you 3 to 6 months of expenses is generally a good rule of thumb to set aside, right? So, if your expenses are, $5,000 a month, right, having anywhere from 15 to 30,000 just set aside in a savings account, right? That's really used as a safety net. That's an appropriate amount. Now, some people are a little bit more cautious than that. Some like to have a lot more than that. Some are a little bit more aggressive, right? They feel secure at their job. They're not worried about job security, and they know their best use of money is putting in the market or elsewhere to really grow over time. So I think first and foremost, get a safety net set aside. That's step one. And I think that's kind of a baseline requirement. Number two is make sure I don't think you want to have too much credit card debt, right? Credit card debt, as we discussed in previous podcasts, have extremely high interest rate. So you want to make sure that's under control. There's argument you could have little amounts of credit card debt to keep your credit score high, but you want to make sure you don't have a ton of credit card debt because those interest payments will really eat at what you're trying to do long term. And then from there, you want to like list out goals. If you have a good sense of your cash flow, you can then kind of get a little bit more directed. How much should you be investing? We always tell all of our investors, even if they're a little bit tight on cash flow, if you can contribute at least $50 a week, $100 a week, right? Some small amount just to get it really going. And I think you even had some really good compounding interest stats that we can go through. But the time to invest is yesterday.
Yeah, and I think a lot of people, especially now that we're I guess a little bit older, than we're not 20 anymore, always say, "Hey, I'm gonna wait till I have more money." Right? I just started working. I'm not making anything now. I'm making minimum wage. I can't save enough. It's not worth my time. Right. But I actually think it's the opposite. I think that's the right time to start because some easy math here. If you were saving $1,000 a month from 20 to 30. And why I picked 20 to 30 is your expenses are pretty low then, right? I have 2 kids now. You have one on the way. Your expenses are about to go up, right? Mine keep going up every single month. So it's easier to save when you're younger, even though you might not necessarily have as much, right? So you save that, you get an 8% return. By the time you turn 60, you have $1.8 million. Wow. All you saved was for 10 years from 20 to 30.
Wow.
Now, if you said, hey, I'm going to wait till I have more money. I'm going to start at 30. And I'll save $1,000 a month, but I'll save till I'm 60. So you're going to save 3 times as much money. You know what you have at the end of that 30 years at 60? You actually have less money than if you started at 20.
Really? Less money? Even though you saved in principal 3 times the amount.
Yep. You only have $1.5 million compared to 1.8.
Wow. That's incredible. Yeah, that's the power of compound interest.
Yes, it's much more important to start when you're younger, right? Even if you don't necessarily have, $50,000 to invest, $100,000, right? Yeah, invest $1,000 a month, $500 a month, because that'll help you so much more long term than waiting to have that $100,000 to invest.
What does Warren Buffett say? Compound interest is the
8th wonder of the world.
8th wonder of the world. Yeah, that makes sense.
Yeah, and that's the goal, right? It's we want to keep being able to save and invest because that's the importance of starting early. But how do they actually start? What does that look like?
Yeah. So if you don't have a financial advisor, and I don't think everybody out there needs one, but if you're not comfortable with a lot of these things, or you can always do some research online. Again, I'd be cautious of listening to TikTokers or Instagram influencers out there. But the first step is really to understand your budget, right? How much are you willing to set aside each month to invest for the long run? Again, even if it's not a large amount, putting away $50 a month, $100 a month, that'll compound over time and really be a significant amount. So step one is, you can open up a brokerage account, right? So there's a lot of brokerage accounts out there. Vanguard is a very easy one to use. Fidelity, Schwab, there are, some robo-advisors out there that make it very easily for you as well. And then you can typically just kind of like automate your investments. If you're not sure what to invest in, Joe and I mentioned just getting broad-based market ETFs, or you can't go wrong with them. And I think start there. Yeah.
Is it better to do it on a monthly basis, or just saying, hey, at the end of the year, I'm getting a bonus and now I have, $20,000. Let me throw that in.
Yeah, good question. So personally, I think you want to make sure you're doing monthly, right? You want to make sure you're building up habits, especially for investors who haven't really done this for the first time outside of their 401k. I think building up habits is a very important thing. And then can reassess, if you have large bonuses or larger distributions throughout the year, you can always do lump sums as well.
Yeah, I think, when I speak to some people, they get very nervous to say, oh, I have all this money that I'm sitting in cash, but the market's too high.
Right.
I can't put the money in now, right? The market's going to drop. And what's the stat? The market goes up 75% of the time?
I think it's closer to like 80% of the time, right?
Yeah.
So the market's up 80% of the time in a yearly basis. Historical stats, right? Large cap stocks, the S&P 500 historically, right? I think since 1928 has gone up on average 10%, right? Between 10 and 11%. So that means, I don't know, you do the math. What's the rule of 72? So you're essentially doubling your money every 7 years. So every 7 years, your money is doubling. Now, the market will never go up in a straight line, right? It's never going to go up in a straight line, right? It's going to come with some fluctuations, right? This year we're up 16, 17%. The last 2 years prior to that, we were up over 20%. But remember 2022, right? The market was down almost 20%, right? And investors really felt that. So with these great returns, right, the price we pay to achieve these returns is volatility. So that's going to come with volatility. So that's why it's very important to build out more of a diversified portfolio so that you can kind of ease those waves.
Right, and not own one stock specifically.
Exactly, right. Yep.
I hear a lot of concerns from clients, or just talking to people in general, is, oh, I don't want to invest because I don't want to lose any money. What would you say to someone like that?
I would say then maybe the stock market isn't the place for you. There are other investments out there where you can have principal protected securities. But I think that kind of begs the question, like, what is the reasoning for investing, right? Why is it so important for people to invest?
I think the timeline also, right? When I hear that question, sometimes it's a 20-year-old saying, I made, $30,000 the first time I made something, I don't want to lose it. Yeah. But they don't necessarily understand that the market's not going down to zero, right? If you're talking every single company, Amazon, Apple, both, going bankrupt, Google, every big name company. No, I think they're just nervous about the market dropping. Right. And they're saying, oh, I see my value drop. But if we explain that the importance is investing over time, right, and letting that money compound.
Yeah, absolutely.
Right. I think, what is it? The market goes up over 20 years. It's like 100% guaranteed to be up.
Yeah, I think it's even like 15 years, right? So there's statistics on it. Like over any 15-year period throughout history, you've made money 100% of the time. Now, again, past performance is no guarantee of future success, but it is how we kind of track a lot of these things, right? Coming back to the question, like why do people invest in the first place? I think that question is very important, right? Because you got to understand why you're doing certain things. And I think at a baseline level, right, it's to return money on capital, right? I give you, or I invest $100 today. I hope at some point in the future it's going to be worth more, right? And the biggest thing now is really to outpace inflation, right? Historical inflation has been right around 3%. Now it's gone up and down, right? We saw inflation over at like 8-9% during the pandemic and 2022. But the goal is to beat inflation, right? And I looked up an example. A can of soda in 1995 was 35 cents, right? Jeez. Today, it's $2.50, right? So that's a 615% increase on the cost of a can of soda, right? So that at its baseline is what inflation is, right? Things cost more today, for the most part, than they did 20, 30 years ago. So the idea of investing is you want to make better return on inflation, right? You're not going to do that by having money just sitting in a cash or checking account, right? Historically, you're making 2 to 3% there. So if anything, barely keeping up with inflation, if not losing money to where inflation is. So people invest for the long run so that they can retire, right? People don't want to be working till they're 70 or 80, right? If you have goals of retiring at 60 or 55 or even 50, right? People want to invest so that that compound interest can really make up that difference in what they need to save for retirement or other future goals.
Yeah, I think that's important, right? The idea is to let your money grow because, my expenses keep going up.
Yeah.
And I look at inflation over just the past 5 years. My food bill, I think
through the roof.
Food inflation was like 10% over the pandemic, right? Which is a lot more than 3%. So you need to necessarily get the market to help offset that because we're not looking at 1 year. We're looking at 20, 30, 40 years.
Exactly, right? And I think that's why it's so important for young investors to learn about the stock market and other options out there versus just putting it in a savings and a checking account, because you're not going to get ahead by doing that, right? You need to be investing your capital. You need to be growing that money so that you can outpace inflation and that you're not feeling stuck paycheck to paycheck over time. Yeah.
Not only even retirement, even thinking about buying a house, right? Like, I think you own your house already, but if you kept all your money sitting in a bank account for 10 years waiting to buy, it'd be a lot harder because even the prices of houses keep going up.
Yeah.
So you have to figure out a way to be able to get there.
Yeah, absolutely. One other question I wanted to ask you, Joe, touch on, I get this a lot. Like, people are looking at stock prices, they see the market over time, like it's based on what determines whether a stock or the market in general goes up or down. Like, can you give us or give our listeners like a broad overview of, macro level, what trends really cause stocks to go up or down in the long run?
Yeah. So the idea is that you're buying a company, right? The idea that means not only are you just buying a company because you like the name, or Apple because I use an iPhone. I believe that Apple is a successful company and it's going to be making more and more money. So the way the idea is that if I'm buying these companies are going to make more money, so they're more valuable. So the ownership that I have in that company will keep increasing in value, as opposed to hoping, when the market drops, it's, for example, the pandemic, all of a sudden sales dropped, so the company wasn't as profitable. So the value of your company was less profitable,
right,
less valuable. So that's why the market keeps fluctuating, right? And a lot of it is going to be this, supply and demand, right? If there's more shares available,
that's right,
less shares available for what people actually want to buy. Mm-hmm. But what do you think?
No, I think that's it, right? I think at its baseline, it comes down to a supply and demand issue, right? When more investors want to buy a stock than sell, right, prices generally rise. And when more want to sell than buy, the price falls. And that many factors can contribute to that happening, right? There's a lot of macroeconomic factors, like where interest rates are going. Are there geopolitical risks at play? We had the whole, earlier this year, right, with the whole Trump Liberation Tariff Day, he was threatening 200% tariffs on some of our biggest trading partners. So people immediately reacted to that because they know that's going to, if those tariffs were enforced, that's going to affect future cash flows of some of these largest companies. So that's why we saw massive fluctuations. Same with COVID, right? The whole world was shut down for a very brief period until the U.S. government stepped in, put in massive stimulus into the economy. So those are factors of it. And then earnings reports, right? So companies report earnings on a quarterly basis. They give outlook on, how they're expecting to do this year, what their future outlook is next year. So all these different factors kind of contribute to why stocks rise and fall on a daily basis.
Yeah, it comes down to their profitability. Yeah. Right? That's the idea, is that most investors want to be investing in a company that's profitable, right? You don't want to have a company that's not profitable, because then what are you actually buying?
Yeah, that's good. All right, good. So Joe, I guess question for you: how would you get started today? Right, you're a young investor. Let's say you're contributing to a 401k at this point. You have some money in savings account. Let's say you don't have any big financial goals in the next year or two. Like, what would you be doing, and how do you get started today?
Besides calling Bobby and me? I think definitely want to get a brokerage account opened. You don't have to overthink it, right? There's a lot of these broad indexes. You could buy the S&P 500. You could buy some international indexes, the total stock market index, but just get money flowing into something, right? The idea is that doing something is better than doing nothing. Yeah. You don't have to stock pick. You don't have to go and say, I'm going to study every single company. Let the market do it, right? Just buy the market. The market's going to go up and down. But if you're thinking for the long term, over the next 5 or 10 years, the market should go up, right? Hopefully. So that's the idea, is just let that money grow for you and not overcomplicate it.
Yeah, I agree. I think that makes sense. And then for those out there that are interested in getting a little bit more financial acumen out there, understanding the market more, right? There's things you can do online to read, right? Wall Street Journal is a great place to start. The Financial Times, CNBC. And as always, you can always reach out to us at Power Forward Group, the team here. We're happy to have a conversation with you guys. and see if we can help out in any way.